franchise with partners. I exclusively did multifamily only since 2010. I sold that firm back to my partners in 2020 and just went solo into multifamily advisors with myself and my staff members. We cover the northern half of Florida from Orlando and Winter Haven and Lakeland all the way up to Tallahassee, Jacksonville, Daytona, Gainesville, Ocala, all those markets. I do anything over 10 units, conventional or student housing, and occasionally I'll do development sites.
Very good. So when we talk about the markets, obviously it's all of northern and central Florida, except the Tampa area, and I think Orlando you're covering too. But maybe you can tell us a little bit the differences between these main markets that you're covering.
Yeah, sure. So I guess you can start with, the northern half. When you remove Orlando, a lot of them have the same metrics, meaning the same closing prices a unit, the gross rent multiples. A lot of the rents are the same. It's amazing. I mean, even from Jacksonville to Tallahassee to Gainesville to Daytona, all those markets trade around the same. As a matter of fact, if you lump them all together, the average closing price a unit right now in the northern half of Florida, not including Orlando, and this is across Class A, B, or C, is $85,000 a unit right now, right? And that average rent in place is $893 a month. The average size unit is about 812 square feet. The average age is a late 1970s versus an Orlando/Tampa. Now, keep in mind, obviously, it is a larger market. It has more population. It does have more jobs, but the metrics are a little bit insane. So for that same, those same metrics, you're closing at an average of $198,000 a unit in those markets, if you can imagine. And now the average rents are about $1,325 a month. You're closing at about $198 a square foot, which is amazing. And the average transaction, though, instead of being late 1970s, is late 1990s, right? So a 20-year newer product. Now we can drive into Class A's, B's, and C's, and we can talk about that. But in general, obviously the market is very hot. The market is very hot, especially from a pricing standpoint, because basically you have low interest rates and you have a super low supply of assets to come on. Now, the reason that there's a low supply of assets to come on is a couple things. Number one, in November and December of 2020, there was a huge number of sales. In fact, 26% more sales happened in November, December 2020 than November, December of 2019. And the reason that happened was because of the presidency. They didn't know who the president was going to be. Didn't know if capital gains was going to go up, didn't know what was happening with the 1031 exchanges. And so those who might have waited until 2021 went ahead and said, hell, let me go ahead and cash out now. Okay, so a whole bunch of transactions happened November, December that would have happened in 2021. Then in January, which is the election month, obviously nothing happened then. When normally January and February is where a tremendous number of listings come on. In fact, I usually tell a lot of my customers, let's not come to market in January, because no matter how good your asset is, you're going to be competing against all kinds of other assets, right? But what happened in January and half of February was nothing came on. And so as a result, as of mid-March, and we're working on the new closings now, but as of mid-March, with Orlando included, there has been only 14 closings. Now, I did just look at another 10. So I think through March, we've had roughly 24, 25 closings in the entire northern half of Florida, over 10 units. I'm not even talking about over 100 units, over 10 units, roughly 25 closings in the entire northern half of Florida. Now, I will say in the last 45 days, so call it March and April, the number of BOVs that I and my broker friends have done has skyrocketed. The number of listings has gone up. You've probably all seen this who are listening to this podcast. You're starting to see a lot more listings come on. which means that May, June, and July, the number of closings will get back up there. Now, we're not going to be at 2018 and 2019 levels in terms of number of closings, because what's happened is in the last trailing 3 years, we've had a little over 30% of the inventory trade, right? Now, what happens is so anywhere between 6 and 10% of inventory typically trades per market per year. But we've had roughly 30% in the last, call it 3 years plus the 4 months in 2021. And so you might say, okay, well, Beau, so there's 70% of the inventory that hasn't closed, but you have to think how many of that 70% has already refinanced, right? Probably another 20% has already refied in the last 12 to 18 months, and you can't buy those because the defeasance is going to be too high. And then how many of them are owned in long-term funds? So no matter how big of a price you bring them, they can't entertain your offer anyway. And how many of them are in locations that you probably wouldn't buy anyway? And how many of them are owned by a person who would sell, but they're the kind of person who says, this is my price, and the price is absolutely ludicrous, right? So when you get down to it, the reason that there's not a whole lot of stuff that had come on the market, and therefore that's why prices have gone up, is because most of the deals that can sell have sold, right? And then the ones that do come on the market, they know they're at peak pricing. So there's no way around it, Anton. You're going to have to, there's always going to be multiple bids. There's always going to be a dog and pony show. You have to put your best foot forward, and there's a bunch of things you can do to make yourself more attractive, and there's a bunch of things you can do to make yourself less attractive. But off market, quote unquote, off market listings don't really exist. I have that word gets thrown around a lot. And if you want, I can define for you, Anton, what off market means to a lot of people, but what it actually is in practice.
Yeah, very good point. We see that all the time. So many newcomers to the game say, "Oh, I got an off-market deal," right? And we already know that same deal has been shown to dozens of orders by multiple brokers.
Correct. Brokers are fantastic at making an investor feel special. Hey, sure. Anton, listen, I just got a call from seller Sam. By the way, he's thinking about listing this next week. I'm the only broker he's talking to. We got to take a run at this, right? Yeah. But brokers had that conversation dozens of times. It doesn't make any sense for any seller on the planet to sell to one human being, to give one human being who he doesn't know a chance at buying his property. And if he does, if he's any good, that seller is going to want you to pay a premium for the right to not go to market, right? And for a broker, it makes no sense for any broker to talk to one human being as a buyer, right? So if a seller called me and said, "Hey, Beau, we're thinking about selling our asset. We don't want to list with you. We don't want it on all the websites, but you really are the only guy we're talking to. We do want you to take it to your database." Then it doesn't make any sense for me to just call Anton. Sure. And say, "Hey, I got this opportunity." Why would I do that to myself, right? I'm a race against the clock. I need to show my seller that I'm talking to major buyers. So I promise you, it is extremely rare that buyer Bob happened to call seller Sam, and seller Sam has never talked to any broker ever or any other seller, and buyer Bob caught seller Sam on the best day of his entire life and somehow convinced him it makes more sense to accept his below market price rather than getting 15 offers from a broker in 5 days and making people bid against each other. Never happens.
Yeah, right. Particularly after that seller has been receiving calls from every broker in that market.
And listen, this is, I'm mostly talking about the 50 plus unit world, right?
Sure.
I mean, 50 plus unit world is a sophisticated world. Every owner knows how the market works. And most of the time it's over 20 units. It's once you start getting below 20 units, below 50 units, yes, there may be some less sophisticated folks. Maybe it's a mom and pop. Maybe it's a 40-year-old guy who inherited a 32-unit asset from his parents who passed away recently and doesn't know what he's talking about. And some guy calls him at just the right moment before a broker called him and sells to him for some discount. But I mean, but if you made your life going after off-market deals and that's all you went after, I'm telling you that you are one of the slowest, worst investors on the planet, because simultaneously I can show you dozens and dozens of human beings that go after every asset on the market or not, who are trading at a clip that far surpasses anybody who concentrates on just off market.
Sure, absolutely. Yeah. You also touched on, right, the defeasance yield maintenance, right, as a reason why a lot of deals are not coming onto the market.
Sure.
You mentioned refinancings, even the acquisitions that were done over the last 2, 3, 4 years, particularly the ones that were done in the 2018 range when interest rates were higher. A lot of these deals have such a high yield maintenance or defeasance cost attached to them that, yes, the values have gone up tremendously for all of these owners, but yield maintenance defeasance essentially would kill all the profits or the majority of the profits.
Right.
And buyers don't want to assume a loan that is in the 5% range plus, right? So
yeah. And sellers don't want to leave a bunch of money on the table. I mean, they're bringing in plenty of cash flow. They have plenty of profits. Why not wait another couple of years when the defeasance is lowered or gone? Because in any market, multifamily is going to be sought after, right? I mean, unless there's some, nuclear attack, I don't see values going in reverse anytime soon. All I see is, I think we're at a point right now in, call it April/May of 2021, where cap rates truly have compressed so close to the borrowing rate that I do believe we have reached kind of a maximum. So I believe by the end of 2021, we're going to go from the 10 to 15% per year increases in values per unit to a more normal, right? So it's going to go from like this, as I'm holding my arm up almost straight up, to a more normal. Now, that's like I said, values are not going in reverse. That's not happening, buyers. That world's not going to happen anytime soon. It's only going to be a slowing of the appreciation rate, just because there is no more where to go. I mean, the northern half of Florida, it used to be where a 5.0 cap was a phenomenal deal. I mean, was a very high price deal.
Right.
We're in the 4.5 cap range.
Yeah.
Right. In markets in which I've never seen before. Now, Miami's, the New Yorks, the Californias, they've been in the high 3s and low 4s, for a long time for a bunch of different reasons. But to have that in the northern half of Florida has been pretty scarce. So now a 5 cap is the new 6 cap. Like if you can find a 5 cap good property in a good location that has remotely value add to it, you should jump on it.
Yeah. Yeah. So how do you see the difference between the A, B, and C from a cap rate and price per unit perspective?
So of course I track all that stuff.
Yeah.
So the way I track it is not just A, B, C. I actually break it down into subcategories. So I go class A, B plus, B, B minus, C plus, C, C minus, and then I track affordable housing separately, right? So in the northern half of Florida, again, removing Orlando, because Orlando would throw off all the metrics.
Sure.
So across all the transactions that have happened, A class is basically a new construction deal. That's the only thing that can be A class. Every now and then you could get a 1990s asset that could be A class, as long as it was kept up on the remodel and is in a phenomenal location. Otherwise, it's very hard to compete against a new construction in order to earn that kind of standing.
Absolutely.
So new construction class A right now is running about $220 to $230 a unit, right? And those rents are between $1,500 and $1,600 a month on average.
Yeah.
The class B plus, B pluses are running roughly $180,000 a unit. Now, keep in mind, when I give you an average, that could mean that could go from 170 to 190, 195. But the overall average, when you combine all the stats, is running about $180,000 a unit. That's about $1,350 a month on the rents. A B class is currently running about $135,000 to $140,000 a unit. And that's about $1,100 a month rents, A B minus is $95,000 to $100,000 a unit. That's a little over $900 a month rent, almost $950 a month rent. A C plus is now $85,000 a unit. And those are about $825 a month rents. A C class is $70,000 a unit for about $750 a month rents. And a C minus is running about 45, basically under $50,000 a door.
Yeah.
And those are usually under $600 a month rents, but sometimes they can be in the sixes. But all of these have increased over time dramatically. I mean, it's been pretty incredible.
Yeah, it certainly has, right? And we see it all across the country, obviously, right? Where whatever was trading in 2010 for 10, 15,000 is now exactly in that 90 to 100,000 range.
Yeah.
Right. So as you already mentioned before, that run up that we have seen was just absolutely extraordinary, and expecting that it just continues at that pace, obviously, is not really realistic. We may see another year or two where it just goes in that direction. But at some point we are just hitting a limit of how low the cap rates ultimately can go, right? Until you get that close to the borrowing rates where it just doesn't make sense anymore, right?
Well, and Anton, I mean, I just hate cap rates altogether. I've got
Sure.
I've done a video on this before, because cap rates are really they only really mean anything on new construction, because cap rates take into consideration the fact that you couldn't do anything to it to improve it, right? I mean, a cap rate is only good if the buyer is buying the seller's income that can't be increased. You can't improve the vacancies. You can't improve the expenses. It is what it is. And then a cap rate means something. The reason a lot of the deals are trading for low cap rates isn't because of the cap rate, it's because the cash on cash return and the IRRs can be, the future of those rates translate into a low cap rate, right? So if you can buy a true value add property, not just what a broker calls a value add, but a true value add property, they're looking to achieve a 6 to 8% cash on cash return within 2 to 4 years, right? That could easily translate into a 4.5 cap if it is a, call it a 1985 property that's $300 a month under market or $200 a month under market. The guy buying that doesn't give a shit about the cap rate. He's just paying attention to what his return is in the future with debt.
Sure. Yeah. I mean, I couldn't agree more with that focus on cap rates is really problematic, right? Also, what are the expenses that you're actually using to come up with that cap rate, right? Have to be normalized, or does someone have higher expenses than market, below market? No one really is looking at that. No one is truly normalizing it outside of the institutional space. Obviously, in the institutional space, everyone runs in a very narrow range with these properties, and their cap rates are much more applicable. But particularly once you get into the B and then the C space, as we know, expenses are all over the board, right? And unless you kind of standardize the expenses for a particular property and the size and the market, it's very hard to say what the true cap rate is. Of a
it really is. And one of the biggest things I caution investors on is, and it's mostly newer, to call it newer intermediate investors. The first call I get is, hey, Beau, saw your so-and-so apartments. What's the cap rate? I know I'm talking to someone who doesn't do this regularly, right? It's because it's not an educated question. The question would be, what can the rents get to? They want to get granular on the expenses, right? I mean, you really have to dive into the expense part of things. The taxes, the insurance has gone crazy nowadays.
Sure.
Can you make the repairs and maintenance run one leaner? Do you already have management efficiencies in the area? There's so many factors that affect, sort of the return for every individual that, it's silly to pay attention to cap rates. And as a matter of fact, you're going to lose out on a whole bunch of deals, because I can tell you that I could name a million buyers over the last 20 years I've been in this business that have passed on deals that they wanted a certain return year one, which makes no sense. Whereas 3 years from now or 4 years from now, if I showed them how this property was performing from a cash on cash standpoint, would they have cared that they were quote unquote overpaying 4 years earlier for that asset? And the answer is no, right? But they get so scholastic and so sold on that first day of financials and how they look to their investor makeup that they lose out on a lot of deals.
Yes. Yeah. No, I agree. Obviously, in ideal world, you do not overpay for a property, right? But as long as it's a seller's market and you compete with other buyers, well, it's your choice. Either you buy a property or you don't, right? So you touched on taxes and on insurance, which obviously is a hot topic with everyone in a lot of places. On the taxes side, what have you seen? Have you seen differences from county to county in the markets that you're covering? How aggressive the assessors have become over the last year, and what you see to how it's going to be this year?
Yeah, awesome question. So on property taxes, here, let me tell you what I do, because as you know, in the industry, lenders, investors, everybody uses the 80% of purchase price rule, right? And so I started in 2016 trying to quantify that rather than just using 80%, right? Because 80% can sometimes kill a lot of deals for a broker when they go to list it. And I wanted to know if it was actually true. The answer is yes, 80% is still the way to go. However, let me tell you the study that I did, the report that I did, and how it varies. The way you as an investor listening to this podcast, the way you should be doing it in any market you cover, is you need to go to the property appraiser websites. The property appraiser websites, especially in show me states where they reveal all the closings, Florida is one of them. You would go in, and so for instance, you would look at 2019 sales. So let's say you only bought 100 plus unit deals, conventional, whatever it is. You'd go to the property appraiser website. You would export every single sale that happened of that kind of sale into an Excel spreadsheet. And you would list, the property, the address, what it sold for per unit. And then you'd go in and you would take the 2020 assessed value, which would be what that municipality now deems that property to be worth. And what you do is you divide the purchase price by the assessed value in order to come up with a percentage.
Right.
And when you do that in a macro sense within markets, you can get a pretty good indication. So what I found was that in some markets, like for instance, in Tallahassee, last year, it was about 70% on average. Now, there were some instances of 80%, and there were some instances of 60%, but the overall average was 70%. Now, I understand as an investor and a lender, if there is even one instance in which an 80 happened and 13 others at 70, investors try to use the 80%. So I get it. Whereas in Jacksonville right now is running 86%, right? Gainesville was running 80. Ocala was like 65%. But I still believe 80% is a reasonable measure. And then if you're in a hyper competitive bid, the way you can try to win some deals is to play the Russian roulette and look at the stats and see, okay, there were 16 closings in Jacksonville in 2020 of the type of asset that I buy, and 11 of them were at 70%, 2 of them were at 80%, and the balance of them were at 75%. Then that's a way, because your other investors are probably not getting that granular, and you can use a 70% assessment and beat that person out on that alone, and still have a pretty good comfort that that's going to happen. And if it didn't, to be able to argue that with the municipality, showing them all their closings along with your consultant that says, hey, 13 times of the same asset that I just bought, you did 70%. How is mine any different? And it's hard to answer that.
Yeah, it's a great point, right? Going granular in these instances is really important, and it's also from a financing perspective, right? So at the high level, when we do quick quotes, we use that 80% as a standard because we cannot dig in deep, right? But as someone gets into the final stages of an offer in the best and finals, that very often makes a difference, right? And as you know, right, the expense underwriting on the financing side has an impact on the NOI, which has an impact on the DSCR and the loan proceeds.
Right.
And whether a lender's appraiser is using 80 or 75 or 85 will have an impact. And that's where we get involved early on also with the buyers to make sure that we find an appraiser that is comfortable with 75, let's say, in a particular market, right? If you talk to just one appraiser, they may say, well, we based on what we have seen, it's 85. Another appraiser may say, I think I could support 75. Well, that makes a big difference, right?
Anton, if you let me share a screen, I'll just show you a quick spreadsheet
Sure.
for the viewers. So I'll do this. I'll just show you like Jacksonville, and I'll show you a couple other spots.
Sure.
Let me know when you have that. It says right now I'm disabled.
Yeah. Okay.
And that way the viewers, when they see the spreadsheet, they can see how to set up their report. Okay. So yeah. Here we go.
Should be able to do it now.
Yep. So as you can see this right here, this is Jacksonville, right? So I've got the name of the complex. These are actual closings in 2019, right? So these are all the closings. Whether it was a market rate deal or student housing deal or affordable housing deal, the date it closed, the year it was built. This is what it sold for. This was the assessed value.
Beau, I'm not sure that I see that you have started sharing your screen, but it's
it paused. Okay, hang on a second. How about now?
It still has started. Maybe it's the wrong.
Share. Resume share. Very weird. Huh.
Is it the right screen?
Yeah, I don't know. It said it asked me to resume share, but let me try it one more time. Does that work? Still no?
Yeah, it's still just
okay. Whatever.
Okay. So
we'll continue on. Anyway, I was just going to show you graphically. If anybody's watching this, if they want to see what that looks like,
yeah, they can reach out to you, right, and they get the statistics there.
No problem.
Yeah. Okay, very good. On the insurance side, obviously, Florida is. I'm based in Texas, right? We have a lot of natural disasters on an ongoing basis. Insurance rates have gone up like crazy. Yep. Florida is another one of those markets, as we know. So, what have you seen where the insurance cost has gone up, and have you seen differences between along the coastal areas like Jacksonville versus when you go a little bit further inland, or does that not really make sense?
Not as much. I mean, it's now, on the low end, $700 a unit a year up to about $1,100 a unit a year, depending on the size of the asset. Yeah. And literally like 2 years ago, maybe 3 at the most, but probably just 2 years ago, it was half that.
Yeah.
I mean, an insurance deal to be $350, $400 a unit, that was where it was. And sure. Now it's more than double. And it's become something, it's quite significant. And a lot of it's liability. A lot of it is the assault clause. I've talked to some insurance guys about it before, but it's pretty crazy. And it's actually closer to the $1,000, the smaller the asset.
Yeah. And if you do not have any type of
umbrella,
coverage umbrella, right?
So, yeah. So that's another tip. As you accumulate more units, if you can put them under a bigger umbrella, those guys are able to get things back down to call it 2018 levels by lumping them all with one carrier and all under one umbrella. That helps a lot. Now, when you go to sell that asset later, you have to imagine that the next buyer won't have your abilities and your power and your size. But at least during the hold, it can boost your turns.
Yeah. In your market, do you also see that some property management companies offer their own umbrella insurance for property owners?
Yeah, at minimum, they have connections with those who they have their own portfolio and their management portfolio under. So it's definitely worth checking, but it
Right.
depends on the market, right? The larger the market, the bigger the property management players are. Whereas the secondary and tertiary markets, they could still have great managers for that market, but they don't have the power of sort of the reach, if you will.
Right. Yes, definitely. Yeah. It's a very good point. Now, here again, right? So if you're a buyer, right? So you look at insurance rates, taxes we already discussed, but whatever the current owner has in insurance cost doesn't really matter, right? You need to talk to your insurance broker early on to get a sense of what that property will cost, because that's also a lender will use the new rate that you have to pay as a buyer. No one cares what the current owner is paying, right?
Yeah. The good thing is this is the one section in which everyone's kind of on the same playing field. Other than the giant organizations that can put under an umbrella, it ain't like they're underground insurance company that's able to do some incredible, offer and beat you out.
Sure. Yes.
The same folks for the most part.
Yeah, absolutely. Yeah. Now, switching gears a little bit, I think you have a unique model, right? When we look at your marketing, obviously you're a multifamily broker in Northern Florida in the markets you already have mentioned. I think what is unique of what you're offering is that you not just saying, look, we are listing your property, but you have access to essentially the whole broker community through Brokerage. Now, in reality, having been in that business for a long time, while co-brokering is a common thing on the residential side, virtually everyone does it. In the commercial space, it's unusual. And so maybe you can tell our listeners a little bit how you are able to achieve like co-brokering even with the large firms that may not be that willing to co-broker with you.
Yeah. So, I mean, the co-brokering becomes sort of non-existent in the commercial investment sales world, right? So like retail leasing, office leasing, industrial, small office building sales, anything that's non-income producing in the commercial real estate world, co-brokering is still very prevalent. That exists. That's a real thing. You want every broker to be a part of it and help you fill those specific spaces.
Yeah.
The reason commercial investment sales is largely a non-co-broking world is because everybody wants that asset. Versus like if you're selling a 10,000 square foot office building, it's a needle in the haystack trying to find the right buyer who wants that building to move their business into. And so as a listing broker, you want to open your world up to every broker. In the investment sales world, no broker on the planet is worrying whether or not he's going to sell that apartment complex. It's going to sell, right? In fact, our whole job is to choose the right buyer among dozens and dozens of across the world. So the reason most brokers don't co-broke in the multifamily world, and this is primarily in most of the nationals, right? Because mostly the national companies, the Marcus & Millichap, Stewart Dallas, Colliers, Cushman & Wakefield, it's not because they're being nasty or they're not being a sharing company. It's because they don't have to, right? Most multifamily brokers have developed a tremendous database. It's a very small world that buys these assets. Okay, there's literally only 993 owners in the world that own every asset over 10 units in the northern half of Florida.
Yeah,
means there's only about 2,000 that own every single one. Actually, there's less than 1,500 that own every single one in the state of Florida. Small world, they're all in the database if you're worth a crap whatsoever as a broker. And so literally the touch of a button, I'm already able to put my listing in front of everyone in the world that could ever buy it. Now, so that's why co-broking is not necessary. And so if you are a broker who's representing a buyer and you bring it to that broker, you need to be paid by the buyer, because most likely that broker doesn't need your buyer. He's already got 15 or 50 that wants to buy it.
The reason I'm able, and the reason, also the other reason most brokers aren't able to co-broke is you have to understand how they're made up, right? So most brokerages, they have either a franchise fee and or a corporate fee, desk fees. Most really good brokers are partners, right? Because it's hard to do it all yourself. So it's you and some other guy who are killers in your field. And you'll usually have anywhere between 2 and 5 staff members. You have lots of salaries. You have all the costs. And so I have calculated that most national brokerages that have a 2-partner format keep between 20 and 35% individually after all costs.
Yeah.
Paid $100,000 commission, they're making 30 grand. The actual guy that you worked with, right? And there may be 2 partners and each of them get 30 grand. But after everyone's paid and the corporation's paid and everything paid, for me, I own my company. I don't have partners. I don't have franchise fees. I don't have companies. I have 1 staff member, and then I sub everything else to other companies, right? So I have lots of outside companies that I sort of pay pro rata to, not salaries. So I keep I think my expense structure is roughly 8 to 10%.
Yeah.
Total with salaries included. So because of that, I can offer to my customer, when you hire me, you get Beau Beery, you get C.B. Richard Ellis, you get Colliers, you get Cushman & Wakefield, you get ARA, you get all the big boys. And yes, most of the buyers who they would talk to will have already received my asset, but I'm happy to co-broke with any of these guys. It makes my job easier. If they've got a tighter relationship with some other buyer, happy to it, right? Mm-hmm. My job is to bring my seller the biggest price possible. And if I can expose it to as many people, human beings as possible, great.
Yeah. Okay. That's a good point. Right. Obviously, you're in that niche, so you can offer it to the big boys, right?
Yeah.
And how has the reception been with a JLL or a CBRE, Cushman with?
Frankly, because they have so many of their own assets they're working on.
Yeah.
Multifamily brokers don't typically do buyer representation.
Right. Yeah.
It's a needle in the haystack business. Even if you have the best buyer on the planet, you're still going to compete against that seller's 15 or 20 other offers.
Absolutely. Yeah.
You hook up with a buyer and go around and submit offers to sellers or listing brokers is a waste of my time, because I can go out and find my own listings that I know are going to sell.
Sure.
So, it's very rare, even though I offer a co-broke to anyone and everyone, that I actually end up doing a deal with another broker, because they either get beat out by other buyers that I have coming at me, or they don't give it the time. And I get that. I mean, I get it.
Yeah. Yeah. Okay. But at least you're offering it, right? So it still broadens the reach, right? If they happen to have someone you don't know, right? So at least it's
nice to have a partner. It's almost like, I don't ever look at it as adversarial. It's not like brokers become a partnership. We both want the same thing. We both want to close this deal. And I love when a broker has a tighter or better relationship with that buyer, because, if something comes up in a transaction, they can do the arm twisting or the arm holding if needed, not me.
Yeah. Yeah. Very good point. Yeah. Very good. So looking forward for the rest of this year, where do you think Northern Florida is going?
Yeah. I think the number of transactions is going to significantly increase from the first quarter. I think pricing probably August, September-ish is going to kind of top off, where you're not going to see any more like huge spikes. And it really depends. A lot of this depends on what happens with the Biden tax plan that's now being pushed around, right? Most investors I've talked to do not believe the full 44.3% capital gains tax will get approved. I do believe something in between will. I've heard 28 passed around, right? But whatever happens, if an actual increase actually happens, what has happened historically when that happens, what happens is, so for instance, let's say September, Biden announces, there's a pretty good chance this is going to happen. I have a bunch of people on board. We're going to get this passed. Then the fourth quarter of 2021, brokers are going to sell a crap load of real estate, right? And then what will happen is in 2022, the number of sales will slow way down because people are thinking, oh God, I'm paying 8% more, 10% more, 20% more, whatever it is. And then by 2023, transacting comes back, maybe not to full normal, but it's on the way back to normal, because what happens is what I call the COVID effect, right? So when COVID happened in March of 2020, the world stopped. Everyone was scared to death. Nothing happened. Nobody transacted. And then everyone kind of says, this is the new world. This is the way things happen, and we got to get back to life. And then transacting came back to normal for the most part. And that's what happens with taxes. It feels like the end of the world, and it sucks. And there will be a year of turmoil where number of transactions will actually all be done by a small number of us brokers, right? Because what happens is in a tough tax year, people use the best brokers, not their cousin from church who occasionally sells apartment complexes, right? But usually things get back to normal the year after that plan comes back in.
Yeah. It's a good point. You really get, everyone feels that that's the new normal, right? And you have to live with it. At the same time, right? As an investor, whatever investment you do that has the capital gains attached to them, it's not just limited to real estate. It's stocks too, and any other asset, right? So everyone gets hit there, right? So
right.
That's just. But
if you're in real estate, you have to get back to real estate, and that's what happens. All the people you and I work with on a regular basis, Anton, are in real estate in some way. It ain't like they're going to stop their life because of that. They're going to figure out ways to transact again, and that's what's always happened throughout the history of the world.
Yes, absolutely. And so obviously there will be some new strategies, right? Whatever it might be, right? Obviously, bonus depreciation is already being phased out. Maybe there are some changes to the depreciation benefits too. But even if they are not, maybe there is less aggressive depreciation initially, so that you do not have that big capital gains tax with the recapture at the end. So who knows, right? Everyone will have different ways of running their strategies.
You there?
I'm here. Yeah.
Now I can hear you. I don't know. It just kind of went.
Oh, okay.
So, I can hear you now.
Yeah, okay. Very good. All right. Very good, Beau. It was a great conversation. Thanks for sharing all your knowledge, right? Particularly you have that niche in Northern Florida. And I would say there are a lot of, obviously, Florida owners and buyers in that market, but there is only a lot of interest from across the country in that market. For some time now, and I think it's only will continue, because Florida as a whole is an attractive state to be invested in. It's obviously apart from the insurance side, taxes, we have an issue everywhere, but it's a landlord-friendly state, so that makes it only attractive. So how can our listeners reach you? And I think you also have a book that you have written, so maybe you can also mention that in addition to your contact details.
Sure. Three ways to reach me. Number one, I did write this book that's it's done very well. It's called Multifamily Investors Who Dominate. It's on Amazon in hardcover. It's on Audible. It's on Kindle. But the book is all about how to get flooded with listings from brokers and sellers first before anybody else sees them, right? So it's got step-by-step processes. The other way to reach me is I have a website called beaubeery.com, BeauBeery.com. Now, the reason you want to go there, no matter what market you're in, I don't care if you're in the Texas market, New Jersey, Florida, whatever it is, at the top of the website is a section called resources. And when you click on resources, all the markets I cover drop down. For your market, you want to master every metric and every number and every button I have in each of the markets I cover, because the more you can master the metrics that I have on those sites, the faster you can react to opportunities in your markets. And the third way to communicate with me is my YouTube channel. So I have a YouTube channel called Beau Knows Multifamily, BEAU, Beau Knows Multifamily. And on that channel, I talk about how to buy more assets, how to sell them for top dollar, and how to do market analytics very, very good so that you can react to opportunities.
Yeah, excellent. I would say when our listeners look at your website and all the statistics that they find broken down by markets that you're covering, I would say it's hard to beat. I have not seen it with any broker anywhere, whether they're large or small in that market or in any other market. So just that information alone is certainly very valuable, obviously for someone who is actively looking in your market, right? But as you have said, it's even valuable information if you're not looking in that market, just to see what you're tracking and give an idea of what the prospective buyer or an existing owner may want to track in their home market where they have properties or targeting properties, because that's a very valuable way of knowing what is really happening in your own market that you're interested in or own property in.
Yeah, I agree.
Yeah.
Well, thank you for having me. I do appreciate this, Anton.
Yeah, thanks, Beau. It was really great having you on and you sharing all your wealth of knowledge, and wish you all the best for the rest of 2020.